slap your logo on the side of your car or on your back window, and now it's a marketing expense. You're gonna get audited, and the IRS is gonna be like, no, bro, that is not a marketing expense at all. Hi, I'm Nate. I'm the founder of Cookie Finance. I've been a CPA for 12 years. Cookie Finance, we are an accounting platform for content creators to help you with your bookkeeping, taxes, and so on. And today we're going to be talking about auto deduction for content creators. So let's start by talking about what is a write-off or a deduction. People use these terms interchangeably because they're the same thing. A deduction, a write-off, a business expense, it's all the same thing. A deduction is just a legitimate business expense that lowers your taxable income. So a legitimate business expense means an expense, this is IRS talk, it's ordinary and a necessary part of your business. Those are expenses that you can write off. So if it's contributing to your business, it's a part of your business, it's helping you build content, build your audience, build that trust with your community, build engagement, those are going to be things that are deductible. And part of that could potentially be an auto deduction. And if you're curious about other deductions that you could be taking as a content creator beyond the auto deduction, we have a link down below with our deduction cheat sheet. It's a great 2-pager that goes through all the different deductions that you can be taking as a content creator. So follow that and download our deduction cheat sheet. So the first question is, can you write off your car as a content creator? And the answer is you can potentially write off a portion of your vehicle so long as you use your vehicle more than 50% for your business. If you use it less than 50% for your business, then you can still write off the mileage you use as part of your business, but you just can't write off a portion of your car. So if you use your vehicle more than 50% for your business, then you can potentially write off a portion of your vehicle. So I just reacted to a TikTok where someone was saying, you can buy a supercar and write off 100% of that supercar. You can buy $300,000 G-Wagon and write off 100% of it if you're driving that G-Wagon to your different shoots and to whatever. That's all terrible, terrible advice. Don't do that. So let's actually walk through what it means to write off a portion of your vehicle. So we're going to use the example of you use your car or your vehicle more than 50% for business purposes. Well, there's something in the tax code called Section 179. And what that means is you can write off potentially 60% of the purchase price of your car that you buy this year immediately from your income. So if you buy a $100,000 car, it's 100% used for business. In 2024, you can write off 60% of that immediately in that year that you bought it. In 2025, you can write off 40%. And each year it's burning down more and more. It used to be 100%. Each year is kind of burning down. So in 2025, you can write off 40% of the purchase price. But you can only write off 40% of the portion that is actually business use. Now, we strongly recommend that you do not say 100% of your vehicle is business use. So let's say that you go and buy a new Chevy Tahoe this year and you spend $75,000. I don't know what they cost. You spend $75,000 on a new SUV this year, and you want to write off that 60% of it in the first year. Now, you can only write off the portion that you use for business purposes. That's a little bit tricky. That's a little bit nuanced, and it's up to you to figure that out. But it's disingenuous to say that 100% of it is used for business purposes. If you do that, you put yourself at a much higher risk of getting audited, because I can guarantee you use a portion of your vehicle to run down to the gym or to take your kids to school or whatever it might be, you most likely use a portion of your vehicle for personal expenses. Now, if you are in the construction industry and you have a pickup truck and it's used for hauling lumber and materials and things like that, sure, I'm sure it is used 100% for business. But if you bought the car personally and you use it for business and for personal, do not put 100% because that will put you at a much higher risk of being audited. Now, within that 60%, what about the other 40%? So let's say you bought a $100,000 car, write off 60% of that this year. What about the other $40,000? Well, the other $40,000 you are going to write off over the next 5 years that you own the vehicle. So even though you don't get it all in the first year, you can still write off the rest of it over the next 5 years. Now, another thing that you'll see all over TikTok and everywhere else is that in order to get this deduction, the vehicle needs to be over 6,000 pounds. And then everyone uses like the G-Wagon as the example. I don't know why. I mean, I guess the G-Wagon is cool, but I mean, most cars these days, including a lot of electric cars, are above 6,000 pounds. So pretty much any SUV is above 6,000 pounds. Even a lot of electric vehicles are above 6,000 pounds. So what they say, people on TikTok, so on, it has to be over 6,000 pounds to get that deduction. That is completely false. Now, you do get a bigger deduction in the first year if it's above 6,000 pounds. The idea behind it is, once again, going back to the construction industry. The IRS put the tax code in place assuming that anyone who bought a car or vehicle above 6,000 pounds for business purposes was probably buying like a pickup truck or something for like a construction type of job, and not expecting, content creator to buy an SUV, which is totally fine. You can do it. If it's above 6,000 pounds, you just get a larger portion of it deducted in that first year, but you can still write off a big chunky portion of it, even if it's below the 6,000 pounds. So don't go buy 6,000 pound just to get the deduction. It applies to even things below the 6,000 pound limit. And usually this deduction, to take advantage of that section 179, writing off a 40 or 60% of your vehicle, only makes sense if you bought a vehicle this year. So if it's 2025, that's when we're recording this, and you buy a vehicle in 2025, then it actually makes sense to write off, a portion of the vehicle, that 40% this year, and then spread out the rest over the next 5 years, at least the business portion of that 40%. Now, if you bought the vehicle in years prior, you can't catch up on that depreciation on that section 179. You can't say, well, I spent $100,000 on a vehicle last year, and for 2025, I'm going to take 60,000 of it and write it off this year. That's not how it works. So typically we say, if you bought a vehicle last year and you're thinking about this year's taxes, it usually makes sense to just use business mileage. Now, how that works is the IRS, depending on what year this is that you're watching this, but right now it's 69 cents. For every mile you drive, you get 69 cents of a deduction. So if you drove 10,000 miles for business purposes last year, you can write off $6,900 of your vehicle for this year. So even if you didn't buy a vehicle, you can still take advantage of that mileage. Now with that, you cannot take mileage and write off all the gas, repairs, maintenance, and everything else. You can't do both. It's either or. Either you write off the actual expense of the car, you take that 60% and all of those actual expenses, or you take the mileage. And a general rule of thumb, but you should work with a tax professional to actually figure out what's best for you. But a general rule of thumb is if you bought the car in years past, most likely taking the mileage is going to give you better tax deduction. And if you buy the car this year in 2025, most likely taking the actual expense is going to make more sense for you. Now, in the next couple of years, as it goes down to 20% and then 0%, all of that can change a little bit more, but we'll kind of have to see what happens with the tax code. Okay, so then the question is, how do I determine what percent of my car is actually business related? Because as a content creator, you are your business. The business and personal are completely merged together. So how do you determine what's business, what's personal? Now, if you're a creator doing lifestyle and you're constantly going to different locations around your town, you're constantly driving out to the country, and you're constantly going to restaurants and all these different places, or if you're a travel creator and you're constantly traveling with your car and so on, it's a little bit easier to kind of figure that out, right? Like how much during the day are you using your car to build your content, go to the store to get supplies, materials for your content, and so on, versus how much of it is personal. Now, here's another thing we see on TikTok and other places is just slap your logo on the side of your car or on your back window, put your Instagram handle, and now it's a marketing expense. Like you're now using your car for marketing, and now you can write off 100% of the vehicle. That will get you audited faster than anything. No, that's not a marketing expense unless like you really think you're getting tens of thousands and hundreds of thousands of followers because your car has your logo on it, you're gonna get audited, and the IRS is gonna be like, no, bro, that is not a marketing expense at all. So don't try to play that game. The IRS is looking for legitimate. Are you actually using this to get around to these different things? How much are you using it for business purposes? We had a creator once who tried to do that. He bought a brand new Porsche, wanted to like slap his logo on it and write off 100% for marketing. That's like just opening yourself up for audit. So let's talk about the risk of taking the auto deduction, because there are certain items within the IRS, within your tax return, that make you a higher audit risk. And one of them is the auto deduction. Now, the IRS knows that people use this, sometimes abuse it. You're not going to, but sometimes people abuse the auto deduction. So it immediately raises your audit risk by taking an auto deduction. Now, if you're smart about it, if you're being pragmatic, you're not saying, my new Ferrari, I'm running off 100% because it's marketing. If you're not doing that, but you're being smart about it, you're doing an appropriate business percent use, most likely you're not going to get audited. It's when you try to get super crazy with it, that's what increases your audit risk. But just know that by taking an auto deduction, automatically your audit risk does go up. So just be smart about it and don't go too crazy with it. Okay, so then how do you keep track of these different expenses and mileage? So let's talk about if you're taking the mileage deduction. There are a whole bunch of apps out there that you can use to track your business mileage. You just go on there, hit start. I'm like starting this journey for business purposes, and then it logs all of those trips for you. Then at the end of the year, you have a nice, good record of all the mileage that you drove for business purposes. So that's probably the most efficient. If you really want to go old school, you can like pull up an Excel spreadsheet. Every time you drive, you can like log the mileage that you drove. We'd recommend downloading a mileage app. There's a bunch of them out there. They're all free. There's some that are paid, but there's a bunch out there. Use a mileage app to track those miles. That's going to be the best way to do it if you're doing the mileage. Now, if you're doing actual, this one, you should have a nice income and expense tracker for your business in general. But on this expense tracker, every time you get gas, every time you pay your monthly insurance, every time you have to go get your tires changed, all of those things you need to be tracking in this spreadsheet. And then at the end of the year, you can take a portion of those as a deduction for your vehicle. Now, once again, if you only use your vehicle 75% for business purposes and you had $10,000 worth of gas, insurance, and all of that, you can take $7,500 of that $10,000 as a deduction this year. Once again, usually it makes sense if you bought your car in years past, just take the mileage. It's a lot easier. But if you do have a ton of it, you're driving all over the place, ton of gas, tons of repairs, everything else, it might make sense to do the actual. But really that 69 cents per mile is a pretty big number, and it really should cover almost all the gas, wear and tear, and everything else. And usually mileage is going to be the better bet if you bought your car in years past. All right, if you would like any more tailored advice for yourself, feel free to reach out to us, set up a meeting. You can book a 30-minute free consultation with our tax team, our accounting team, and we'd be more than happy to walk you through any of these questions on auto deductions, any deductions in general, and you can get this tailored advice for you as a content creator by professionals who understand this space better than anyone else out there. Put in the comments any other questions you have about deductions or taxes for content creators, and we'll answer them in a future video.
Tax, bookkeeping, and accounting services exclusively for content creators and influencers. That's Cookie Finance.